Welcome to lesson 4 of the Value Investing Bootcamp. Enjoying it so far? Good. In today's lesson I'll guide you through the process of defining realistic investment goals. We'll talk about time frame, expected returns, and the amount of money you should invest. In order to be able to stick to your strategy, even in difficult times, it is crucial to have a clear understanding of what your investment goals are. There is no one-size-fits-all solution to this, because everyone has their own reasons. Where one is investing for his retirement, others are trying to use the money to get their kids through college or buy a new caravan. But no matter what your goals are, or how much money you plan to invest, it is important to keep the following 2 points in mind, because they help you manage your expectations. 1. Not many people earn a living by investing. It is a way to grow the money you already own. 2. Avoiding losses is the most important prerequisite to investment success. To start with the first point, that not many people earn a living by investing, let us consider a median US household income of around $50,000. Also, in the previous lesson I mentioned that the S&P 500 has returned 10% on average since 1926. This means that you would need to invest $500,000 to earn an annual income of $50,000. Not many people have this amount of money to invest. If you do, great, but it does not matter if you don't. Buffett famously started his career with $100 earned from the sale of Coca-Cola cans, and he did pretty well for himself, wouldn't you say? Compounding even small returns over long periods without loss adds up to serious money. In fact, not a job, but investing gives you the best chance of accumulating significant wealth. This brings us to my second point, that avoiding losses is the most important prerequisite to investment success. Seth Klarman mentions this in his book Margin of Safety, and Buffett even made a rule out of it. Rule number 1 is don't lose money. Rule number 2 is never forget rule number 1. So why is avoiding loss so important to value investors? Well, let's take a look at 2 of our imaginary friends again. Investor A earns 16% a year for 10 years in a row, while investor B earns 20% a year, but loses 15% in the final year. So while investor B outperformed investor A for 9 years in a row, in the end, investor A ended up with more money. As you can see, consistent compounding without loss adds up to more than having volatile returns. The reason is twofold. A loss interrupts the compounding process, and a loss is hard to earn back. To make the second point stronger, let's look at a simple example. You invest $1,000 and lose 10%. You are now left with $900. How big of a return do you need to earn back that $100 you lost? That's right, 11%, which is more than the 10% drop it took to lose that $100 initially. This difference becomes even more pronounced when you lose more money. Let's say you lose 50%, then you are left with just $500. But in order to earn back that 50% loss, you have to make 100% profit. So as this example makes clear, earning back a loss is much harder than incurring a loss. So how can you avoid losses then? Well, by minimizing downside risk, which is something we'll cover in detail in the module about risk. For now, it only matters that you understand that to avoid losses, you must be prepared for the worst and focus primarily on risk rather than return, which is contrary to most investment strategies, which only tend to focus on the upside. Seth Klarman had the following to say about this. Setting a goal for a certain rate of return is futile. An investor cannot decide to think harder or put in overtime in order to achieve higher returns. All an investor can do is follow a consistently disciplined and rigorous approach. Over time, the returns will come. What Klarman means with "over time the returns will come" is that in the short run, stock prices might be unpredictable. But in the long run, the price of a stock will eventually reflect the value of the underlying company. So if you buy low, all you have to do is wait until this happens. In other words, the returns will come. So let's get practical. First, write down what your investment goals are. Why do you want to invest your money in the first place? Do you want to save for retirement? Earn more interest than on a savings account? Get your children through college? Become a millionaire in a day? Or do you just think it is fun to invest? This is a personal question and everyone will answer it differently. It does not matter what you write down, but it does matter that you write something down. Think about it. Done? Sweet. Now write down how much money you plan to invest. To kickstart the compounding process, a sizable initial investment is preferable, but do not put all your savings on the line. Only invest money you do not need in the next few years. Also, never, ever, ever invest with borrowed money. It is simply not worth the risk. I always suggest to invest 10% of your monthly income at the beginning of each month. This way you only put a small part of your income on the line, but these small amounts do add up over time. So why at the beginning of the month? Because if you are like most people, you will probably have spent it all by the end of it. Keep in mind though that you will probably need at least $500 to $1,000 to start investing, or else the transaction costs alone will eat up all the profits you make. Great. Now do some of your goals have a deadline? Write down the amount of time you have until your goals have to be reached. If you don't have a strict deadline, still write down a time frame you are aiming for. Okay. Now, how much money would you need to earn each year to reach your goals in time? Simply take the total amount of money you need for your goals and divide it by the amount of time you have to reach that goal. Write the answer down. Here comes the first reality check. If you compare the amount of money you plan to invest to the amount of money you need to earn each year to reach your goals, does this seem realistic to you considering the average stock market return is 10% annually? Of course, value investing is a strategy which, if applied consistently, will earn you above average returns. It is very well possible to earn 20% annually using a value investing approach. But still, if you need to earn $1,000 each year to reach your goals and you plan to invest $2,000, this means you need a 50% annual return. In other words, this is an unrealistic scenario which might lead to irresponsible risk-taking. In this case, you should probably look for additional sources of income besides investing to achieve your goals. Second reality check. If you look at the deadline or time frame for your investment goals, does this seem realistic to you considering that value investing is a long-term strategy? You might not see the results you want until after a few years. It simply takes time for price to catch up with value. While it can be quicker, this takes on average around 3 years or more. So if you invest with money you need in the short term to pay for your living expenses, you're gonna have a bad time, because this means you might have to sell at a loss, which is what you want to avoid at all costs. Usually, forms like these include questions about your risk tolerance. This one does not, because with value investing, risk and reward are inversely correlated. This means that taking more risks leads to lower returns, and the other way around. Minimizing risk leads to maximum returns. Value investors earn above average returns while taking below average risks. There is no trade-off to be made between risk and return, and therefore your risk tolerance is simply irrelevant. Nice, huh? My final tip will be to compare your performance only to your own goals, not to the performance of other investors or the stock market as a whole, because it is a simple fact of life that you can't spend relative performance. Therefore, focus only on absolute returns. To summarize, it is critical to have a clear understanding of what your investment goals are to be able to stick to your strategy. Not many people earn a living through investing alone. Avoiding losses is the most important prerequisite to investment success. A loss interrupts the compounding process and is very hard to earn back. Focus on minimizing downside risk rather than on returns. Over time, the returns will come. Clearly define why you want to invest and how much money you need to earn each year to reach those goals. Don't invest with borrowed money or money that you might need soon. Invest 10% of your monthly income at the beginning of each month. Check if your goals are realistic based on historical stock market returns, the money you plan to invest, your time frame, and the money you need to earn to reach your goals. With value investing, risk and reward are inversely correlated. Congratulations, you just finished the first module of the Value Investing Bootcamp. Now that the basics are covered, things will get really interesting. Be sure to take notes, because the following lesson about the crucial difference between price and value is jam-packed with valuable information.